Now speaking, Judd Henry, Senior Vice President and Head of Investor Relations. Welcome to T-Mobile's second quarter 2023 earnings call. Joining me on the call today are Mike Sievert, our President and CEO, Peter Osvaldik, our CFO, as well as other members of the senior leadership team. During this call, we will discuss our financial performance for the second quarter of 2023, including our revenue, net income, and other key metrics. We will also provide an update on our strategic initiatives and new projects. Our earnings release, investor factbook, and other documents related to our results, as well as reconciliations between GAAP and the non-GAAP results discussed on this call, can be found in the quarterly results section of the Investor Relations website. We encourage investors to review. Now speaking, Mike Sievert, President and Chief Executive Officer. T-Mobile reported their highest Q2 postpaid phone net adds in 8 years, fueled by both industry-leading gross adds and the lowest postpaid phone churn in company history. T-Mobile also reported the lowest postpaid phone churn in the industry for the first time ever at just 0.77%. The company delivered industry-leading customer and financial growth, leading to an increase in guidance for the year. T-Mobile's dedicated 5G spectrum assets with superior propagation have resulted in a demonstrable advantage in customers' everyday lived experiences, with median download speeds more than double their closest competitor. The company has also launched their Phone Freedom and Go 5G Plus rate plans, which have been met with an amazing response from customers. T-Mobile has seen improved porting ratios against every competitor, including yet another quarter of year-over-year improvement against cable. They have also seen record postpaid phone net adds and their lowest ever phone churn in T-Mobile for Business. The company is substantially complete with both the billing migration and retail rationalization, well ahead of their year-end target. All of these catalysts have enabled a differentiated and profitable growth strategy that has translated into the highest core adjusted EBITDA growth and year-to-date cash flow conversion in the industry. Now speaking, Peter Osvaldik, Chief Financial Officer. Q2 was a quarter of profitable growth for our company, with postpaid service revenue up 5% year-over-year. We achieved an 11% year-over-year increase in core adjusted EBITDA and a 300 basis point increase in core adjusted EBITDA margin. Free cash flow was up 64% year-over-year and we repurchased 25.2 million shares for $3.5 billion in Q2. Our guidance for 2023 has been updated to include total postpaid net customer additions between 5.6 million and 5.9 million, up 250,000 at the midpoint. Core adjusted EBITDA is expected to be between $28.9 million and $29.2 billion, up 10% year-over-year at the midpoint. We expect merger synergies of approximately $7.5 billion in 2023, achieving the full run rate synergy target provided at our Analyst Day a year ahead of schedule. Cash merger-related costs are expected to be between $1.6 billion and $2 billion for 2023. Net cash provided by operating activities is expected to be in the range of $18 billion to $18.3 billion and cash capex is expected to be between $9.5 billion and $9.7 billion. This will result in strong free cash flow of $13.2 billion to $13.6 billion, up approximately 75% over last year. We also expect postpaid ARPU to increase slightly more than 1% for 2023. Goldman Sachs analyst Brett Feldman inquired, "What is the right way for investors to frame their expectations around how you will manage the buyback program going forward, given the strong cash flow and upcoming payments for C-band spectrum?" Mike Sievert replied, "Thanks, Brett. We're buying back shares at a steady pace through pre-designed 10b5-1 programs to meet the authorization of the $14 billion program by September. We've been able to take advantage of additional run rate, and the remaining funds relative to the remaining time suggests a run rate that is consistent with our original thesis. Our board hasn't yet made a determination about the second step, but the inputs to those steps are based on our free cash flow growth, which is on track to reach 75% year-over-year growth this year. This strong momentum suggests another good year in 2024 and gives us confidence that the original thesis of around $60 billion through 2025 is intact. Peter, can you comment on how we're dedicating resources to this versus spectrum and other things?" Peter Osvaldik replied, "Absolutely, Brett. We anticipate up to $65 billion of free cash flow to support $60 billion of potential shareholder remuneration. This includes room for spectrum purchases and other investments. We remain committed to delivering the free cash flow that allows us to pursue the highest value creation opportunities. C-band is included in our assumptions and we are optimistic about the program as a whole." Goldman Sachs analyst Brett Feldman inquired, "What is the latest update on Dish's spectrum option and how would you use the proceeds if it were to be exercised?" Mike Sievert replied, "I can confirm that any proceeds from the Dish agreement have not been factored into our long-range cash planning. We are still awaiting Dish's decision and have granted them additional time to determine whether or not they will exercise their right to purchase the spectrum for $3.6 billion. We are currently in discussions with Dish to explore if there is a mutually beneficial outcome that differs from their initial privilege. The deadline for this is August 11th. MoffettNathanson analyst Craig Moffett inquired, would you have an appetite for more mid-band spectrum, either from Dish or any other source? How do you think about the pacing to get to 8 million households with fixed wireless? Mike Sievert replied, I think it's fair to say that we've always been on the lookout for spectrum opportunities. We're committed to putting that spectrum to work quickly and efficiently for the benefit of our customers and the American consumer. Our 5G network is a testament to that, as we've built the best 5G network in history with the spectrum acquired through the merger. We're always looking for ways to add capacity to our network, which allows us to take share, grow, and meet customer needs. We're still aiming for single-digit penetration in fixed wireless access, and Mike can comment on our progress and expectations. Mike Katz replied, thanks, Mike and Craig, for the question. We're delighted with the performance of our HSI business. We've surpassed 3.7 million customers and are on track to reach our goal of 7 to 8 million by the end of the planning period. In Q2, we saw our highest gross adds yet and a decrease in churn, which indicates customers are loving the product. Our NPS scores remain the highest among any broadband category in America. We're thrilled with the progress. Mike Sievert replied, I'm pleased to report that our mobile network capacity is performing as expected and we are on track to reach our goal of 7 to 8 million subscribers. We have the excess capacity to do so without burdening our capital, and this will be a profitable venture for our shareholders and customers alike. New Street Research analyst Jonathan Chaplin inquired, can you provide us with an update on the evolution of upgrades in the second half of the year and how that affects your EBITDA guidance? Additionally, what is the fixed wireless broadband churn rate on a year-over-year basis for the mature portion of your customer base? Mike Sievert replied, Jonathan, you are correct that looking at the aging of the base is the best way to understand our current situation. As for upgrades, Peter, we are expecting historically low numbers for the rest of the year. We believe this is due to the current economic climate and the impact it has had on our customers. Peter Osvaldik replied, we believe we're meeting customers' needs and desires with our 5G network and devices. 2/3 of our postpaid base already has a 5G device, and they're experiencing a phenomenal network. We offer 2-year financing constructs, which allows customers to upgrade earlier than the competition. We anticipate higher upgrade rates in the second half due to new product introductions, promotional constructs, and our own offers to our base. Mike Katz replied, our broadband business has the youngest base of customers in the U.S. We've seen that churn rates for our mobile customers tend to be higher in the first 10 months and then decrease with longer tenure. We're seeing the same trend in our broadband business, with churn decreasing as customers stay with us longer. This is in line with our expectations and the behavior is consistent with our plan. UBS analyst John Hodgelik inquired, could you please provide some insight into the progress of your margins and how they compare to AT&T and Verizon? Additionally, what is driving the improvement in porting from cable and what is the competitive posture between wireless and cable providers? Peter Osvaldik replied, in terms of margin, there are structural differences between us and our competitors that go beyond ARPU. We have higher switching costs and more SG&A due to our dense network build-out. This means there is a CapEx/OpEx differential when comparing us to AT&T and Verizon. To get rid of the noise, we look at the conversion of service revenue into free cash flow. This is the measure by which we compare ourselves to the competition. We announced today that we are meeting them on the conversion ratio and anticipate expanding it further next year. Mike Sievert replied, John, it's clear that our performance this quarter has been strong despite the increased competition from cable providers. We have seen an increase in port ratios with cable last quarter, and this quarter we have achieved the highest postpaid phone net additions for a Q2 in 8 years, as well as the lowest churn ever in our history and the lowest in the industry. This indicates that the competition from cable is not affecting our results. Judd Henry replied, our business growth this quarter was strong. We saw a significant increase in revenue and profits compared to the same period last year. Our enterprise sector was particularly robust, with a double-digit increase in sales. We're confident that this trend will continue into the next quarter. Mike Sievert replied, we are pleased to report that our business growth this quarter was strong. Our VA, virtual assistant, technology saw a significant increase in usage, with a 40% increase in customer engagement. Additionally, we saw a notable uptick in enterprise sector traction, particularly in the vertical industries. We are seeing more and more customers utilizing 5G and 5G advanced services, which is driving further growth for our company. Callie Field replied, the company had strong performance in phone net adds and phone churn, surpassing Verizon. Profitable growth was achieved in all 3 segments, with positive port trends against AT&T in the SMB segment and consecutive growth in ARPU. The enterprise and government segments also saw profitable customer lifetime values, CLVs, that are rising year over year and quarter over quarter. Notable achievements in the enterprise segment include acquiring new accounts from the largest global asset management firm and a leading global bank, as well as securing government contracts with the EPA and the IRS. The company also experienced significant net adds in rural areas for first responders, highlighting the need for a reliable network for critical response. In terms of the VA, Veterans Affairs, market, the company has gained market share and currently supports over 50% of VA phones. The company's contract also includes providing T-Mobile's 5G internet for VA community-based outpatient clinics, enabling healthcare access in rural areas. The company is also exploring various use cases for 5G applications beyond connectivity. In the retail sector, there is demand for fixed 5G solutions to reduce costs and improve support for older wireline services. In healthcare, large hospitals are seeking ubiquitous connectivity, programmable networks, and private networks in specific areas, which the company can provide through its public 5G network and standalone core. The education sector is also showing interest in leveraging 5G for campus-wide coverage and data utilization. Lastly, the company is exploring federal use cases with the Department of Defense, where hybrid networks and private networks can be deployed for military-specific use cases. Mike Sievert replied, "Our advanced network capabilities and solutions are resonating with some of the biggest and most sophisticated customers, leading to record results in our business group. We've seen a complete 180 from where we were a few years ago, and it's driving momentum." JP Morgan Chase & Company analyst Phil Cusick inquired, "Mike, what trends are you seeing in porting ratios versus other MNOs and MVNOs? Are customers coming in without a phone history or number? What does the fourth quarter CapEx level indicate for 24? Mike Sievert replied, "Yes, our port ratios are improving each month since we launched Phone Freedom against our competitors, including cable. We have sparked intrigue with consumers around the idea of being free from the other guys. Our port ratios with cable have been improving for 9 quarters in a row. Cable is growing rapidly, but 80% of their year-over-year growth is from non-ports. Our industry-leading account growth of 299,000 shows that T-Mobile is winning the switching decisions in high-quality, prime, paying families." Peter Osvaldik replied, "I believe CapEx for next year will be in the range of $9 billion to $10 billion. We have a lean manufacturing approach which allows us to be capital efficient. This is why I wouldn't take Q4 as a jumping-off point for CapEx projections." Mike Sievert replied, "Ulf and team have done an incredible job in delivering ultra-capacity 5G to 285 million people. This is 2 years ahead of our competitors' promises, and the 5G race is only expanding. We are now seeing statistics that show where we are and where we are going. Our ultra-capacity 5G network is capital efficient and has enabled us to stay ahead of the competition." Ulfa Walson replied, "Thanks, Mike. We're proud of our network and the progress we've made in the last quarter. We've increased our mid-band POPs to 285 and are on track to reach 300 by the end of the year. This is especially impressive considering we only had 200 mid-band POPs 2 years ago. On our low band, we already reached 300 2 years ago. It's becoming increasingly difficult to grow POPs as we expand, as each 100 million POPs requires 3 times the effort in terms of upgrading and building new towers. 5G is a great consumer driver, but it's also driving more and more of the business inside the enterprise space. We have 255 MHz of spectrum dedicated to 5G on our midband, and our low band is all dedicated to 5G. We'll increase our midband megahertz to 200 by the end of the year by migrating more LTE spectrum over to 5G. We also have the C-band, our 345 auction results, and our 108 auction results to enhance our 2.5 capabilities. There's still plenty of room for us to grow." Mike Sievert replied, "It's clear that our network is performing exceptionally well. We have 3.7 million high-speed internet customers and the average speeds on our network are twice as fast as our competitors. We're continuing to increase our speeds and have plenty of capacity to grow even further. We predicted 2 years ago that we would have a 2+ year advantage in the 5G era, and that is proving to be true." Morgan Stanley analyst Simon Flannery inquired, "What is the current coverage of the base offer and how will it evolve over time? How is ULF approaching millimeter wave for MDUs?" Ulfa Walson replied, "Millimeter wave technology is an important part of our 5G strategy. We have deployed it in areas with high capacity needs, such as Manhattan and Los Angeles. Our overall approach is a layered one, utilizing low band, mid-band, and pieces spectrum for 5G. Millimeter wave can be used to enhance capacity for high-speed internet, HSI, applications, and we are working with our vendors and OEMs to determine if it is economically and technically viable." Mike Sievert replied, "Our capacity model for fixed wireless access serves the potential of 50 million homes across the U.S. We study every sector from every tower in our network to determine the amount of smartphone usage over the next several years. In areas with excess capacity, we approve applicants for home internet use. Currently, there are about 50 million home addresses that can be approved. Our model is dynamic and we sell excess capacity, so if multiple neighbors apply, the NTH person will get a no. We anticipate reaching 7 to 8 million households with this model, which is capital-free and profitable. We are exploring ways to go beyond this initial model, such as millimeter wave, dedicating mid-band spectrum, non-standards-based solutions, and fiber. We are conducting trials to see if we can crack the code and expand our business. We have 2 more years to run before we reach our initial terminal sizing of his. Peter Osvaldik replied, our capital burden model and fiber investments are all designed to be accretive to our Analyst Day guidance. Oppenheimer and Company analyst Tim Horan inquired, could you please explain why you are not raising fixed wireless prices in light of strong demand and limited supply? Additionally, what impact will the Go 5G plan have on ARPU growth in the coming years? Peter Osvaldik replied, I'll let John comment on the success of Go 5G Plus, but ARPU saw a sequential increase of 20 cents and we expect it to remain generally stable year over year. We have a mix-driven strategy that includes benefits from Go 5G Plus, segmented approaches such as military and 55-plus customers, and enterprise, government, and large accounts with high CLV but lower ARPU. Our focus is on switching and attracting accounts to T-Mobile and land and expand ARPA strategy, which recently saw an exciting update to the guide from plus 1% to slightly over 1%. John Fryer replied, the Go 5G Plus initiative is a front-book initiative that has been performing fantastically since its launch in mid-April. Our porting ratios have increased every month against every competitor and over 60% of the accounts joining T-Mobile are subscribing to Go 5G Plus. This offer provides hotspot data, high-speed roaming in Mexico and Canada, and an easy unlock to help customers switch from AT&T and Verizon. The biggest pain point Go 5G Plus solves is the 3-year contract cycle of AT&T and Verizon, which can take longer than completing law school. Go 5G Plus offers customers the ability to get a new device with the same software as a new customer every 2 years, which is a unique and attractive proposition. Mike Sievert replied, yes, absolutely. We are interested in ARPU enhancement for HSI. Our approach is to add value to our customers' lives by introducing new services and offers, allowing them to self-select their way up, rather than increasing prices. We believe this is the best way to achieve ARPU growth. Citi analyst Michael Rollins inquired, what activities remain to reach the $7.5 billion synergy run rate for this year's guidance and $8 billion next year? What opportunities exist for further cost efficiencies to drive long-term margin expansion? Mike Sievert replied, we have achieved the major milestones for our synergy goals this year. However, we are still working to reach the full run rate of those synergies. We are confident that we will reach our targets in the near future. Peter Osvaldik replied, yes, absolutely. We anticipate that the majority of our run rate synergies will be realized by the end of this year. This will be mainly due to avoided costs associated with site build and decommissioning. We still have a small tail of customers to get over before we can fully decommission our systems, but this should be completed soon. The shift to next year will be focused on avoiding site build costs, which will help us reach our goal of $8 billion in synergies. Citi analyst Michael Rollins inquired, can you provide an update on T-Mobile's view of the role and mix of online distribution versus physical retail locations for device purchases and upgrades? Mike Sievert replied, customers want fast, transparent, simple, and mostly digital transactions, but our industry has been slow to adapt due to the complexity of offers. We are rapidly improving our digital capabilities, applying AI technologies and machine learning to speed up service and meet customers where they are. This could lead to potential efficiencies over time, helping us to continue our successful formula while competing in a cost-intensive market. Raymond James analyst Rick Prentice inquired, when do you expect 5G private networks to become a significant contributor to your revenues, and do customers understand the value of 5G and why they should choose your company? Mike Sievert replied, I agree that consumers want a strong, powerful signal everywhere they go. 5G is the best way to provide that, and we have the highest performing network with twice the landmass coverage of ultra-capacity 5G than our closest competitor. Consumers may not give 5G credit for this, but they still want a reliable signal with no latency, buffering or jitter. On the business side, we don't know when 5G services will become bigger than a breadbasket, but we are well positioned to capture it when it does. We made no promises in our long-range plan, but I can promise that as the market develops, we are perfectly positioned to take advantage of it. Judd Henry replied, thank you all for joining us today. If you have any further questions, please contact our investor relations or media relations departments. We look forward to speaking with you again soon.